They have talked about the BRICS grain exchange. And in it, they say global prices are primarily determined by the Chicago Commodity Exchange. Moscow also seeks to move away from trading grain for US dollars in favor of the national currencies of the BRICS member states. Well, you just saw China cancel a huge grain order with Australia and the United States in favor of buying it from Russia. They will pay for it in yuan, which is immediately convertible into gold, the only other tier one asset on the Shanghai Gold Exchange. They understand what we are doing. They get it. And a lot of what we have been seeing lately are these massive deliveries in Hong Kong, in China, at BRICS. And it's interesting, and almost all of the BRICS deliveries, huge amounts of them, are exchanged for physical delivery.
In today's episode, Andy Schectman talks about how central banks worldwide are reevaluating their reserve assets in response to shifting geopolitical dynamics. Amidst growing concerns about the stability of the U.S. dollar, they are increasingly turning to gold as a Tier 1 reserve asset. This trend reflects a broader sentiment of distrust towards U.S. dollar hegemony, exacerbated by its weaponization through sanctions and confiscations. The BRICS countries, Brazil, Russia, India, China, and South Africa, are at the forefront of challenging U.S. dominance in the global financial system. Through initiatives like the exploration of a common currency and trading in local currencies, they are signaling a unified resistance against reliance on the dollar. This collective effort underscores a desire for greater financial independence and autonomy, as central banks diversify their reserves and explore alternatives to the dollar. They are taking proactive measures to mitigate risk and safeguard their financial sovereignty. The accumulation of gold reserves serves as a hedge against economic uncertainty and underscores a broader shift away from traditional reliance on the U.S. dollar. This evolving landscape reflects the changing dynamics of global economics and highlights the need for adaptability in the face of geopolitical challenges. Now we'll show you the best clips of the latest Schectman's interview with Lena Petrova. But first, make sure you like, subscribe, and turn on notifications so you do not miss out our daily videos. Enjoy the episode.
Weaponization of the dollar. And, if we go back to the previous crisis, 2008 and 9, really the central banks were just beginning to, or the gold market itself was just beginning to ramp up till it reached its peak in 2011. But it was a very, very different time in 2008. And for example, the Fed had a balance sheet in 2008 of, I don't know, $700 or $800 million, not the $9 trillion that we saw it get ramped up to here over the last few years. But I think what's really behind the accumulation of gold, there are a few things. Number one, in 2019, the Bank of International Settlements, which is the most powerful bank on the planet, the central banker's central bank, they reclassified gold as the world's only other tier one reserve asset. And, our media doesn't just do a poor job of telling us what's happening. They do no job. How many people really know that gold was reclassified tier one? Since the end of World War II and Bretton Woods, there's been dollars and treasuries as tier one assets. And then there's gold. After 75 years nearly of it just being dollars and treasuries, why would the central bank, the most powerful bank on the planet, reclassify gold as tier one? And interestingly enough, if you go back 2 years before that, to 2017, when nobody wanted any gold, when people just wanted Bitcoin and S&P 500 and buying Airbnbs to, real estate all over the country to turn into investment houses, no one was buying any gold. And in fact, in 2017, most of the sales that the industry was receiving were people selling, not buying. It was a very unusual time. But that's when the German Bundesbank made a very big deal about repatriating their gold from the New York Fed and the Bank of England. And within a few months of that happening, the Bank of Turkey, Hungary, Poland, the Czech National Bank, the Dutch National Bank, the Bank of Austria, all of these Eastern European banks said, yeah, we want our gold back too, by the way. And they said the same thing to the Bank of England. And in 2018, those same banks, who had most of which had been net sellers over the previous several years, bought more gold as a group than they did in the previous 60 years combined. In 2019, those numbers were almost up 100% by those same players. And then, lo and behold, it must have just been a coincidence. The BIS said, oh, by the way, gold is now a tier 1 asset. Makes you wonder, were they told, get your house in order, repatriate your gold and start buying it? Here we go. And this has been a trend ever since that is accelerating. And yeah, as you were saying, 2022 was a huge year, and 2023 was as well. In fact, over the last 2.5 years, the central banks have bought more gold than at any time in history.
In today's market recap, silver sheds 1.8%, gold down 1% after Fed call. The prices of white and yellow metal retreated on Thursday following the Federal Reserve's 2-day policy meeting, during which the officials decided to keep interest rates steady at 5.25% and 5.50%. Fed Chair Jerome Powell underlined that further progress on inflation is not assured, stressing that the central bank will not ease its policy until officials have greater confidence that inflation was moving sustainably down to its 2% objective. The comments appeared to have weakened investors' appetite for safe haven assets, with all eyes on non-farm employment data expected on May 3rd. Market volatility is picking up across the board, especially in the precious metals sector, with wild moves up and down. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications. Also, if you're thinking about adding crypto to your commodities portfolio, check our pinned comment for some massive sign-up bonuses. Enjoy the episode.
And when you have a central bank like the United States Federal Reserve, and the U.S. government, who find it appropriate to weaponize the dollar as the world reserve currency, it creates very, very, very big problems. And big problems in the respect that much of the world views us as being hypocritical. Where, for example, we can give $200 billion to the Ukraine, but Janet Yellen just does an interview with CNBC and saying, we have now warned China, we have put them on notice that if they give any money whatsoever, even though they're charter members of BRICS and allies, if they give any money to Russia to aid in their war efforts with the Ukraine, we will not only sanction their companies and their banks, but also Beijing itself. Where Janet Yellen is so stupid, or maybe it's just too stupid to be stupid, maybe it's planned, where she goes into Brazil, the B in BRICS, just about 3 weeks ago, and says, it's not enough to sanction Russian forex reserves. We need to confiscate them and give them to the Ukraine. So when you look at U.S. treasuries, which not only since 2000 haven't really done a whole lot because of the suppressed interest rates and then the jack up of interest rates, actually the treasury market hasn't been so great recently. But when you look at the performance since 2000, gold has outpaced it tremendously. But what gold offers, and I think this is really to the heart of your question, what is driving the demand for gold, is that gold is an asset that is not simultaneously someone else's liability. Gold is an asset that, as far as these central banks are concerned, not only has outpaced the bond market considerably over this last 25 years, but has no sanction risk, no confiscation risk, and no default risk. And so what I really do believe, and I find to be one of the biggest contrarian indicators of my career, to your point, if you look at the ETF participation of the West, it's falling at a 45-degree angle. Much of the public has been selling into this rally when the Chinese public has been buying so voraciously that they continue to get trigger stops on their ETFs where they have to halt trading because the demand is so outrageous. Coupled with, as you mentioned, the Chinese buying for 17 straight months in a row. They're the largest accumulator, the largest producer. They don't sell hardly an ounce. And you add into it the rest of the BRICS countries who I believe are finding safety in numbers and de-dollarizing because of the weaponization of the dollar. And instead of putting excess reserves into U.S. treasuries, I believe that gold is replacing the treasury bond in a very meaningful way. And I think that really is what is supporting the price of gold. All of this would nary hardly any U.S. participation in the respect that the common belief is that 0.5% participation for the U.S. public, from Joe and Jane Sixpack to the Harvard Endowment Fund. It's next to nothing. So it's very impressive, to your point, that we see gold doing what it is doing with virtually no U.S. participation. And when that happens, it'll be interesting to see what happens to the real potential of gold when it gets some substantial Western investment behind it, rather than just the world central banks.
What do you think of Schectman's take? Is he spot on, or will he blunder his prediction once again? But most importantly, are you bullish? Post in the comment section if you're bullish despite the massive sell-off, and watch this video right here because it's a perfect fit for you. I see you on the other side.